Ladies and gentlemen, we will have Mr. Neelkanth Mishra. Mr. Neelkanth is the Chief Economist at Axis Bank and Head of Global Research at Axis Capital. He's consistently rated as one of the top economists in India by investor polls. But his influence exists far beyond markets. He serves on the Prime Minister's Economic Advisory Council. He also chairs UIDAI and advises bodies ranging from the Finance Commission to the India Semiconductor Mission. A gold medalist and distinguished alumnus of IIT Kanpur, where, by the way, he ranked 4th in the country. In conversation with him will be Sushmit Patodia, a head of business at Dezerv. Sushmit brings over 21 years of experience in financial services, including senior roles at Accenture, Edelweiss, and Motilal Oswal. An alumnus of IIM Bangalore with deep experience across portfolio management. Ladies and gentlemen, please welcome Mr. Neelkanth Mishra and Sushmit Patodia to the stage.
Thank you so much. First of all, thank you, Neelkanth, for making it all the way to Hyderabad. Really a pleasure and privilege to host you here.
Thank you for inviting me.
Just for some context, I have known Neelkanth now for over 15 years. All of you should go back and Google his first report, which was written, which is the impact of cement roads to the economy of a village. Right? Phenomenal report. I still remember how the perspective that he brought in was quite unique at that point in time. Because we were talking about bricks and he spoke about cement roads in a village.
Thanks, Sachin.
Great. Just to reintroduce Neil, he is very interesting. He is the part-time chairperson of UIDAI and also serves at the Economic Advisory Council. So Neil has ears and eyes from Dalal Street to the main street. Great. To kick it off, we will try and cover the future. My mentor always said prediction is a dangerous game, especially of the future. So with that caveat, we will try and predict something of the future. Let's start from the present, Neil. First question. Trump and tariff, right? I don't think we addressed the elephant in the room. And it's 8:30, so we should, you have seen this play out in various other ways, but this time it seems unique. There's one man who's kind of creating a lot of uncertainty. So would love to understand how you think about a volatile leader in the world and also a volatile policy like tariffs.
No, thank you. I'm honored that for such a large gathering, I get to sort of share my views. And thank you for the warm introduction. The lesson that I think we've all learned over the past 1 year, and as usual, markets were ahead of us. So, there's a lot to learn from markets. The markets caught on to the taco trade very quickly. So I don't know if you were also browsing through Twitter as the sessions were going on. So Trump is now saying, I will not use force on Greenland. What I think is very important for us to understand is that it's a politician's role to stay in the limelight, to grab headlines, grab attention. That's his job. What is for us very important is to see how those comments are reflecting into reality. So, just to give you some facts, global growth this year, the IMF is as close to consensus as you can get. They are now talking about 3.3% global growth this year. With the exception of the 2004 to 8 period, average, or I would say mode, as you know, in statistics there is this most commonly appearing number. The mode for global growth is 3.5%. So despite all the drama that is happening, global economy is going to grow at 3.3%. As per IMF, and I think there could be reasons to upgrade that. Global trade in the first we have global trade data comprehensive till October. Global trade in value terms grew faster than nominal GDP. So contrary to all that was happening on the tariff side, global trade has actually expanded. Trade to GDP ratio has picked up. In India, there were people who were cornering me in April, May, June, or maybe September, October. Tell me what happens. I said, what? I mean, have you ever seen what happened with the first Trump tariffs? There was so much of under-invoicing and trade transshipment from China. You know, the Chinese say we've shipped $100 of clothes to the US. The US says we've imported $55. The payment is happening through Hawala. Indians are not the only ones who are creative with how the capital flows happen. The commodities like shrimp and ores and minerals, there is significant trade diversion. So we are shipping shrimp to China and Japan and all that. And on things like apparel and gems and jewelry, there is some impact, but in gems and jewelry already significant transshipment has picked up. So everything is going via Dubai, Vietnam. Even there is a lot of creativity. So some is going through Budapest, some through Brussels. So it's all going to the US, but it's not directly going to the US. So the lesson I'm trying to point to is that the headlines will always look volatile. What we have to focus on is what's happening beneath those headlines. How will that impact the economy? And there, all that matters is that fiscal consolidation is slowing down. So the headwinds to growth are fading from the fiscal side. Monetary was a huge headwind in FY25. Monetary is less of a headwind in FY26. Monetary will be a tailwind in FY27. And therefore, the economic momentum is picking up as we speak.
This is quite interesting. You know, there's so much difference between narrative and the numbers sometimes that we get caught up in the narrative, which is very loud because it comes from the most followed Twitter handle now. And this is what brings us back to the basics, right? And Neel, you keep mentioning this again and again that let's go back to the basics and look at the numbers. And probably this is the time when we turn our eyes a little bit back into India. You call this the golden age. And of domestic resilience. Let's start with the first question, which is flows. Foreigners keep selling. Ashish spoke about it. $19 billion on $4-5 trillion market cap doesn't mean anything. How do you think about this as an economist? Does it worry you that a lot of people are selling Indian rupee and going out?
It does. And I think we are still seeing the aftermath of trying to peg the currency. So FPI flows are, of course, one part of the currency basket. So let me address the currency thing first because I think that affects everyone. If you notice, we went from about $600 billion of reserves to $700 billion of reserves without any substantial change in valuation. At that time, gold wasn't going up. US treasuries were not really moving around. And that happened without any substantial change in the balance of payments. Right? Because it's not that the current account went into surplus or suddenly we were getting a flood of inflows. That happened because the RBI made the mistake, the cardinal mistake of pegging the currency. So for many quarters, the rupee against the dollar was less volatile than even the Hong Kong dollar. And what that did was that there was a big dip in the hedging activity by importers and by exporters. So what that meant was that the natural demand for dollars that came from importers was not there, and the exporters were bringing in dollars on day one. So there was a very sudden, and if you just do the broad math, goods imports are $750 billion, services imports about 200. So if, say, that hedging ratio goes from 40 to 30, or say 60 to 50, you see 10%, so that's a $90 billion change. And therefore, in 2024, October to December quarter, when finally the peg broke, all hell broke loose. So you would think that if the RBI had to intervene by $60 billion in the cash market, the spot market, and $90 billion in the forward market, what really went wrong? Suddenly $150 billion gone. And it was because that $100 billion extra that came when the RBI had made a mistake of pegging the currency, or the exporters were bringing in the dollars on day one, all of that changed suddenly. Now, there is still a headwind. So there is still an overhang of about $60 billion short, forward short that the RBI has. Clearly importers have panicked. Again, in September we saw it had dipped, the hedging activity had dipped because again there was, I think, a mistake of trying to peg the currency again at 88 or something. When that broke, again there is a wave. So the point I'm making is that there is no balance of payments problem. Our current account at about $40–45 billion, maybe $50 billion, can be funded through net FDI. Net FDI because of FDI repatriation. So as Ashish was saying, we have seen a spate of IPOs, VCs who brought in, say, $500 million are now taking back $1.5 billion, which from a medium-term perspective is a good thing. India is the only large market where VCs are getting exits. And they are now bringing in more money. So inbound FDI is picking up. You can see financials firms are getting a lot of private equity investments. Strategic investors are coming in. Amazon, Microsoft, Google, they've all collectively announced about $70–75 billion of FDI. Apple is doubling down on India. India is now part of Pax Silica. So again, you know, Trump can say what he wants. Besant and Lutnick, I mean, they're may not use foul words, but they're bullies. I mean, they will try to say rude things because that's how they behave internally as well. But the industry in the US is absolutely sure that in the hardware tech supply chain, they cannot survive without India, and they cannot compete against China without India, and therefore investments will happen. So FDI, gross inbound FDI, I think will pick up, is picking up. FDI repatriation has gone from 20 billion a year to 50 billion a year because all the VC capital, which private equity capital that came in a decade back is now seeing good exits. So it's a temporary phenomenon. I think the bigger issue has been the fact that the people who had stopped hedging because the rupee was artificially stable are now starting to hedge again. And in this period, the FPI flows are particularly painful. That almost relentless selling of $300–200 million every day. Should we read too much into it? I mean, I am frankly in Ashish's camp that I don't think there is so much to read. They are also agents, they're not principals. And so if EM funds get inflows, they'll get in. VM flows, see outflows, they'll get out. India, I think we shot ourselves in the foot in a way by doing simultaneous fiscal and monetary tightening in FY25. So if you look at India's forward earnings, this is something that we didn't see in the charts. You know, there's a natural upward slope for a long time, and then between September, October 24 and maybe October, November 25, it flatlines. So as the roll forward benefits that you were getting were being cancelled by earnings cuts. Frankly, we expect that earnings cuts will slow, if not reverse. The last 2 months have been a bit disappointing. So the airline company and a big global auto major in December, one very large, well, 15% of market cap company in January. So they've seen earnings cuts, which I think Nifty-wise, it's not as bad as it used to be. So I do think that roll forward gains will now start pushing up earnings. So then India, on many of the screens that people use, will start looking much better. And for what it's worth, early stage AI investments have also started in India. So I'm quite hopeful and optimistic that at least within a shrinking pool of non-US assets, we should see better inflows.
So just to summarize, and even from my understanding, there was a certain artificial stability of the rupee that the RBI tried, which led to rupee being more stable than it should have been. And when that got unfrozen, it also happened to be coinciding with the FPI outflow, and that led to the rupee depreciation that we saw. And you think majority of that is now behind? That's
absolutely. So perhaps the right way to look at it is that the real reserve level that we were working with was not 700 but 600. So if we had all collectively understood, and including the RBI, that maybe 600 is the right level, if people are hedging, give it to them.
Yeah.
All of this volatility could have been prevented. But what it has done, and I must say that from the currency market perspective, we are in the period of competitive currency debasement. And having slightly weak currency is not a bad idea. So the real effective exchange rate, which is the inflation adjusted exchange rate and trade weighted exchange rate for the country, is now at a 10-year low. So the currency from the perspective of export competitiveness of services and goods doesn't need to fall more. Will RBI come under more pressure in the next month or two? Perhaps it can, because if the US yields keep spiking incrementally, there will be pressure on flows. But given how well our services exports are growing, and thanks to some of the crowd here, and oil prices remain range bound, I think our balance of payments is actually quite healthy.
Great. And the second point that you made, and I just wanted to make sure that everybody gets it, is there is not only difference between what tariff leads to from a narrative number. The corporates or the people who actually have the money in the US behave very differently than what the narrative is. They are probably investing the most they've ever in terms of FDI, and they actually see India as a center for a few industries that was never there before.
Absolutely.
Great. Coming back to India and now closer to home, which is, they say in the US never fight the Fed. And but I believe in India it's always look at what the government is doing. There is some change that's happened over the last few months. Income tax rate cut, GST rationalization, labor code reforms, pay commission. Is there something that we should read into? Because these are actions, these are not announcements, these are actually actions. What should we, as people sitting very far from policymakers, look at this as? Okay, so I know in our neck of the woods, and we are in the same neck of the woods in a way, 2 points make a trend. Sometimes you have to sort of maybe take a step back and see whether there is direct intentionality there. So let me start with the pay commission. Pay commission won't be effective till FY28, but when it is, it will be substantial. So no one knows what recommendation they'll give, but going by prior trends, and there is a certain political compulsion. So it may not be as big as 6th pay commission, which was 80-90% hikes, so people with 2.5 years of arrears. But even in the 7th pay commission, from what I gather, the initial recommendations were more moderate, but the government needed to sort of normalize it a bit. And so it is reasonable to think that about 1% of GDP will be the increase. And the impact of that, as I think Harsha was talking about, the impact of this on consumption is quite substantial. So imagine that you get a permanent increase in your compensation. So then, you buy a bigger house, your kid goes to a better school, you buy a bigger car, better fridge, whatever. So that's substantial. And that actually has a fiscal impact. But this is an FY28 story. And when it comes, it will come with a lot of arrears, because as the chart here shows, it's effective 1st Jan 26, means that there will be at least a 5 to 6 quarter delay. And therefore, about 5 to 6 lakh crores will be in arrears. So there is a substantial consumption stimulus. But boss, that's not timing. I mean, it is every 6th year of the decade, 1st of January, a pay commission is due. It has to happen. So there's no intention behind it, right? The GST revisions that happened, the compensation cess was going to end constitutionally end of this year, fiscal year, 31st March.
And people who were surprised, oh my God, see, look, the government is under pressure, they're doing GST reform. Boss, you should have seen, there were groups of ministers who had been saying that, look, let's merge. I think that was very silly, but they were saying, let's do away with the 12% and merge that with the 5% and 18%. All the government did was took away the 28% also. They said, well, look, compensation says there's a lot of money, so we can just do away with the 28, the 28% as well. And that's all they did. There was no fiscal impact, there's no increase in borrowing. So again, there's no intention that, oh, let's stimulate consumption. In the process, they actually did a lot of positive things, like, car rates were normalized, food processing, so there are a lot of the reset that should have happened in 2015-16, when I was part of the advisory committee to the R&R. So the kind of recommendations that were given then, but were not taken, were now incorporated. The income tax cut was perhaps the only intentional thing that was done, but that was a reward for, I guess, most of the people in this room, or people like people in this room, for being loyal taxpayers, and this was an intention, but it wasn't a consumption stimulus, because the budgeted tax to GDP was still going up, and therefore, and the government fiscal deficit was still shrinking, with investment to GDP flat, which meant that at least the consumption support was not there. Macroeconomically, there was no consumption stimulus in that budget. More importantly, as you said, I guess summarizing Yogi Berra, when I had to make predictions, especially about the future, what should the government be doing now? So what should we expect going forward? And I think the focus of the government on fiscal consolidation, debt to GDP, in this world that is like Japan, US, everyone is blowing through, and Europe now, blowing through their fiscal targets. In China, Chinese central government debt to GDP has gone from 40% to 90% in just the last 6 years. India is an absolute outlier. And which is why I think this is the golden age for entrepreneurship in India, because the state is willingly taking a back seat, saying that, what, money in your hands is better utilized than money in my hands. So as much as the political compulsions may be, I do not want to spend taxpayer money on things that I'm not convinced about. And which is why the cost of capital is coming down. So as much as we complain about high price to earnings, if you think about it from an entrepreneur's perspective, it is really good, because the cost of equity capital is the lowest it has ever been. The cost of debt capital, the 10-year bond yields, it's doing some random things right now, but I do think that the fiscal discipline will keep bringing it down. So I think the government focus will remain on fiscal consolidation. I don't think there is room for fiscal giveaways and supporting consumption and all that. So I don't want to read too much into the data points that have come up. And I also think that, and this may be a bit different from what you heard from some of the speakers, but that's fine. That's why there's a market, right? There are always buyers and sellers. I think it is still going to be an investment-driven economy and not a consumption-driven economy.
Maybe I'm just going to break it down with Neel. It's always, he will, his brain works sometimes faster than most of us. So I'm trying to summarize, and please tell me if I'm right or wrong. So the government has done a bunch of things which looks to us from the outside it was intentional push to consumption, but they actually had the balance sheet already to do it. They went out and did it. It did not impact their fiscal condition. So it was probably moving from left hand to right hand, in other words. But luckily, left hand, I think, was for corporates, right hand was for public, if I may use that analogy. That is first. And the second, and I think this is a very, very important point, which is the golden age of entrepreneurship. I think back in 2014, I remember when our Honorable Prime Minister Modi came to seat, he said the business of government is not to be in business, right? And it's probably taken 10 years for that to start playing out, and I think it's playing out now. And just to summarize what Neelkanth said on that, and it's very, very important, which is the only way that one of the best ways that the government can ensure entrepreneurship picks up is by staying away from asking for capital, right? In economics, we call it crowding out. Yeah. So I think what the government has done, especially in India, is ensured that they stay away from competing for capital with entrepreneurs, right? So today, you can get, it's surprising to me that you can actually get a personal loan for 10%, right? It is unthinkable that you could have got a
or salaried mortgages at 7.1%, or if you are a AAA rated NBFC with a somewhat dodgy first name, even then you can get 15-year money at 7.5%. A power plant AA rated can get 20-year money at 7.9%. These are unthinkable rates of capital.
Pre-tax.
Yeah, pre-tax.
These are all pre-tax.
Yeah. So, right. So that tells you that and which is why you are seeing now a surge in borrowing. So corporate credit demand has actually picked up very substantially. The December, for those of you who track these nerdy things, the December end, the second fortnight of December, the credit growth spiking up by 2.5% or so. Like it went to 14.4% from a 12 handle. There was some statistical stuff there, but there is an underlying improvement in credit demand. And one important thing I want to add, in addition to the cost of debt capital and cost of equity capital, is the focus on reform. And what you're seeing is the government willingly bringing down the number of compliances. And this is not just central government, it is also state governments. So we, through brute force Google searches, unfortunately there is no database for some of these things, so we may have missed out a few. 16 Indian states passed laws last year which brought down the number of compliances, the number of violations which deserved a criminal punishment. 7 states allowed women to work the night shift. So if you think about the expansion of modern trade, or the expansion of beauty salons, or the expansion of restaurants, all of these are very important signals of progress. And I can explain why if there are questions, but you cannot do that without sweating the real estate. And if you have to sweat the real estate, you have to work till 10 o'clock, 11 o'clock at night. And for that to happen, of course, you need to have good law and order, but you also need women to be able to work night shift. So, and I think the fact that we now have a list of, see, very often it is the meta level problem that is the big one, right? So I would see, like one small state got a new chief minister, their team reached out, we want to really be business friendly. Can you tell us how? I said, you have to do ease of doing business. Now, their intention is there, but what do they do? So what has happened is that there is this company called TeamLease RegTech. It was a RegTech, Rishi Agarwal, did this company, and then Manish, TeamLease, acquired it. Their database is now being used by every state government. So if someone wants to really reform, they just go through that list. So that meta level problem has now been solved, and so now that is being used by asking hard questions. So like this, the high level committee, the Rajiv Gauba committee, which is giving a monthly report, and action is being taken against those. So the labor code notification was, it was hanging fire for 5 years or quite a while. It has now been notified because they pushed for it. The QCO, and okay, these are nerdy things but extraordinarily important. The quality control orders, which were non-tariff barriers, there were some companies manipulating the system and preventing imports of essential intermediate stuff from happening. So they are being whittled down, and is all coming from that committee. That committee is asking a question: under what authority have, say, XYZ violations been called criminal? So under the Constitution, the government is allowed to make laws and have subordinate legislation, so basically regulations. But there are 16, 17 of these documents. So sometimes in frequently asked questions, the government departments squeeze in criminal punishment. That if you make the chicken coop with a certain material, you can be thrown into jail. Now, this committee is asking those departments, under what authority have you made these rules? Now, there is still resistance, so as you can imagine, but The very fact that these questions are being asked and there is action being taken and a large number of violations are being decriminalized is, I think, very minute, nerdy type of reform, but extraordinarily powerful.
I think, there's so much that happens behind the scenes. Once a very big journalist told me that whatever gets printed in the newspapers is what they want you to see, but actually what is happening is not getting printed in the newspapers. So I mean, these kind of reforms that I don't think we will ever read or see, but the invisible impact is multiplicative. Now, I'm probably going to take the liberty of, in a way we are lucky. We can skip 2026 outlook and go to 2030 or 2047 outlook because we are not fund managers and our neck is not on the line. So, if I may, request you to paint a picture of, how 2030 or 2031, considering 5 years is now 2031, would look like for India. And if somebody wants to put money in Indian equity markets, wake up after 5 years and see what happens, what is the picture that you would paint for us?
Great. I think that's a great way to think about, identifying where you want to hunt the areas, and then you wait for the price points to emerge and then invest, right? So that's a very good framework to invest. I think that the next 5 years we'll see a lot of construction. Harsha was mentioning that we are kind of year 4 or 5 into what generally a 8, 9, 10 year real estate cycle. I think that's absolutely right. I mean, it can be 12 years, 15 years, 20 years. I think, as Ashish said, it could be city dependent. You can run it. Like, Germany had not seen a real estate down cycle for 35 years. And now they're seeing one, which is why they're in trouble. The Chinese, from 2004 onwards, where they transferred a large amount of PSU-owned housing to public hands, and in effect, 35% of GDP worth of wealth was created because it was transferred at a below market price. And that then triggered the mother of all real estate construction. So I think India also is on a very good position. So I don't know if it ends in 5 years or 10 years or 15 years, but the two measures I look at are price to income ratios and inventories. Both look extraordinarily healthy to me. So we've seen a bit of a slowdown because we had artificially tightened monetary conditions, but I think the next several years is going to be about real estate. One of the things that I have now started to rely on, so as I travel, it is remarkable that when I went to Coimbatore for the first time, I said, oh, this looks like Vietnam. Because Vietnam does look like that.
Vietnam?
Yeah, because when you're driving around, the roads are clean, the factories are well painted, so it's a higher per capita income economy. Vietnam is significantly richer than us. You go to the poorer parts of Indonesia and say, "Ye to India lagta hai." Right? So because certain people at a certain per capita income, you see the prevalence of branding, the amount of money that a shopkeeper has to spruce up all of that. So as our economy grows from here, I think that the demand for better quality houses. There's a 2.4% increase annually in the number of households. An average Indian lives in about 130 square feet of constructed space. In a tier 3 town in China, it is 550 square feet. And tier 3 towns, I'm not cherry picking, they are 80% of constructed space in China. So a lot of the steel, cement that has gone in is to build that. US is 700 and still growing at 1% a year. So there's a lot of room, because as people become more prosperous, if you think about each of us, khana to utna hi khana hai. I mean, so we're not going to eat, maybe the calories will be slightly more expensive. You'll start eating quinoa or something, right? I mean, though even that doesn't digest well for me. But my point is, if you become more wealthy, you start to get into a slightly bigger house, a better car, maybe kids go to a better school, you start wearing more brands, but otherwise, where do you spend? And therefore, I think real estate and construction is something that I think becomes very important. Financial services will
sorry, but this is the answer you don't only give in Hyderabad. Just to be the crowd's favorite. So this is your answer in any city.
In any city.
Okay.
And so I'm talking about at a national level.
Yeah, just
so
joking.
when I know what you're saying. So, so at a national level, when I see cement volumes growing at 8-9% in the December quarter, and in the month of January and February, again seasonal, but cement price increases are going up despite supply increases happening. These are all good signs that construction is happening, because cement cannot be stored, there's no inventory, it can never be used alone, it has to be mixed with sand, which means the trucks are moving, construction equipment, a lot of those things happen, right? So, that's a very good, powerful sign. The second is, as you become more prosperous, you can afford to have brands. See, I don't know if there are old enough people here, that growing up, you could see that people bought edible oil from that big canister in the shop, and then would pour out 1 liter and 2 liters. Then we got into packaged edible oil. These are very basic things, but I think packaged food, processed food, you look at the percentage of money the Japanese spend on food is, of course, much lower than India, but 15% of their expenditure is restaurants. Yeah, so the consumption basket is a lot more about eating out, because you can afford to. So every parent here was worried that its kids are ordering too much food in. That's the trend. They're going to eat a lot more of stuff. And so as that happens, the quality of food available externally also starts going up. And because people demand it, and so these are or the prevalence of brands. So all of those things, I think, become important. Financial services. So in fact, the way to accelerate GDP growth, there's only 3 ways you can grow GDP. You add more people, add more capital, or grow productivity. Now in productivity, I think we are already the best performing student, right? So 1.5–2% a year. I think faster than that for 1/6 of humanity is very difficult. Labor input, more demographic sets it up. We are getting more women into the workforce, which is our own doing, which is good, but you can't really grow that very fast. So then capital input has to grow. Now capital input, as much as you would like everything to be equity funded, a lot of debt has to come in. And so what debt means is that people are borrowing from the future and spending today. And you will see that in history, starting 1650, which is quite a while back, the people had started saying that there is a paucity of precious metals. Gold and silver are not enough, and that's why money creation is not happening. That was the first time some economist, maybe there was no field called economics at that time, and the Americans therefore had started using land and real estate as collateral to generate credit, because that is how money comes into the system. So credit has to grow for the economy to grow, and therefore, as some of the speakers were saying as well, I think we should expect faster than nominal GDP credit growth, NBFCs and banks. Profitability and return on equity, I think, will be challenged, because there is a lot of supply that is going in. Every PSU bank, this is the first upcycle where the PSU banks are healthy, because and they can just outprice the safe assets, which is why salaried mortgages are a no-go area for everyone other than a PSU. AAA rated corporates are a no-go for everyone other than a PSU, because they will just kill the pricing. I heard of a public sector bank, a public sector undertaking, a gas pipeline company, which got 1 year money at 5.46. Wow. Exactly. So, and this from a PSU bank, of course. So you will see a lot of competition, but I think the top line growth, so if you can disburse credit profitably to the right channels, things like wealth management, asset management, because as Indians get wealthier, financialization of assets, InvITs, REITs, all of those things I think are going to expand. On a relative basis, I am less positive about consumption. While branding, I said, there will be formalization and all that, but this is a period where inequality is going to go up. And this is not me prescribing, because this is not how I would like it to happen, right? Because I would like it not to happen, but it's inevitable that labor is in surplus, capital is in shortage. The pricing power of labor is weak, and therefore low-end consumption or consumption which is proxy to low-income households is going to struggle. So there may be periodic upturns like the pay commission whenever it is implemented and the cash starts flowing, but otherwise I think those would be no-goes. Some of the export businesses may not do that well. I mean, IT services, again, one of the speakers was mentioning they're not very positive, neither we. But I do think that, commercial, residential real estate will do well, financial services do well, some of the high-end discretionary, autos, etc. So these are the segments, if you compare yourself to on a per capita GDP basis, you will see that. And one last point, economies also have balance sheets. So we are used to seeing companies and countries have balance sheets, but economies. So what I like to look at is, say, whenever we hit $20 trillion of GDP, we will be about $13,000, $12,000, $13,000 per capita, which is close to where Malaysia is today. Now, if you see, Malaysia is not very large, but I mean, among the economies that I can see in that band, it's the largest. So, if you see their capital stock is, infrastructure, housing, roads, bridges, etc. And there is also plants and machinery. Everyone thinks that investment is about plants and machinery. But in Malaysia, only 11% of capital stock is plant and machinery. 81% is residential real estate, commercial real estate, and infrastructure. A lot of this is going to be, has to be built. So that construction is something that, therefore, I'm very positive.
Neelkanth, to give an answer, goes from 1650 to 2050. So again, let me try and summarize this 400 years in 40 seconds. You're saying people will continue to want bigger houses as per capita consumption, as per capita GDP grows. The only thing you can really spend on is another square feet, not another meal. So bigger houses, which has resulting downstream industries which would get impacted, cement, steel, etc., etc. The second is branded consumption, and I think this is something that we haven't seen growth in India on a secular basis. We have had a lot of cyclical up and down in branded growth, not seen secular. The third you said is financialization, and that I think is for everyone to see. I think probably we can also touch upon after this very quickly on your thesis about how digitization and financialization go together. What you're not bullish on is FMCG, if for want of a better word, so that everybody can understand, which is fast-moving consumer goods. And I kind of understand where you're coming from when you go from $1,000 per capita to $2,500. That's what explodes. But when you go from $2,500 per capita to, let's say, 3,000, 4,000, 5,000, yes, nothing happens there because you can't brush more than twice a day. Right? Very interestingly, I was reading somewhere the last 7 years, not a single year FMCG industry has posted a double-digit volume growth. Right? So testimony to that. And in all this, there will be continued pressure on profitability because we are capital short, labor surplus. Have I got it right?
Yeah, the last one on the profitability side, I think some of the segments like financials, because there is a lot of supply going in, so we have to be careful, and some of the banks and the NBFCs have to work really hard to be able to maintain their profitability and ROEs. But in general, I do think that profit share of income will go up. So profit should grow slightly faster than nominal GDP.
Super interesting insight. But we should break now. Thank you so much. I enjoyed and learned a lot, and I hope all of you did too. Thank you so much, Neil.
Thank you very much. Thank you.